The market is currently closed, and the last recorded closing price for Lucid Group Inc. under the ticker symbol LCID was $5.36 per share, registered at the close of the trading session on Thursday, June 18, 2026 at 4 p.m. Eastern Time. While a 4% gain on that final trading day might tempt some short-term traders to think a bottom is finally in, a much darker reality is unfolding behind the scenes that most retail investors completely miss. The headlines focus on production counts, but the true trap for anyone looking at this company right now is a massive pending securities class action lawsuit tied to allegations that management covered up a devastating 29-day delivery halt of their cornerstone Gravity SUV. The gap between what the company claimed about overcoming quality control issues and the operational reality of secret production pauses due to defective supplier parts has left early buyers holding heavy losses. When you see a company lose significant shareholder value in a matter of weeks because preliminary revenues came in at $280 million against Wall Street expectations of over $433 million, you know you are no longer just dealing with a slow vehicle rollout. You are looking at a fundamental breakdown in corporate transparency, compounded by a dilutive $1 billion capital raise that continuously penalizes anyone holding the stock for the long haul. The general expectation built into this stock by optimistic retail crowds has always been that it represents the ultimate luxury alternative to massive players like Tesla stock, offering unmatched battery efficiency and high-end design that could capture the premium electric vehicle market. People logging into their favorite online trading accounts often view it as a high upside bet that could mirror the early trajectories of mega-cap giants like Apple stock or Nvidia stock if it manages to scale up production. This narrative is incredibly appealing when you are scanning through various online investing platforms or managing a self-investing account, looking for that one beaten-down luxury player that could return to its historical highs. The expectation is that the sovereign wealth backing of Saudi Arabia makes the business practically immune to bankruptcy, providing an endless safety net of capital that allows them to burn billions while perfecting their assembly lines. This safety net assumption leads many individuals to accumulate shares on retail platforms, assuming that the downside is artificially capped by international billions. The reality, however, is that an endless cash cushion from a sovereign wealth fund does not automatically translate into public market equity gains for everyday shareholders. When a company continually relies on private placements and dilutive secondary offerings to keep the lights on, the percentage of the company you actually own gets chipped away quarter after quarter. If you look closely at how institutional desks handle this through advanced platforms like Interactive Brokers, you will notice that sophisticated funds are not treating this like a buy and hold asset. They look at Interactive Brokers' trading volumes, short interest metrics, and Interactive Brokers' fees to structure complex hedging strategies rather than outright long positions. Having an Interactive Brokers account allows these large players to short the stock or write options against it, capitalizing on the persistent operational friction that plagues the company, while everyday investors using basic online investment portals are left simply hoping for a sudden turnaround that never comes. Recent stock movements show an alarming trend where every minor relief rally is quickly met with institutional selling pressure. Over the past few weeks, trading volumes spiked significantly during down days, which indicates that large blocks of shares are being distributed to unsuspecting retail buyers who think they are getting a bargain at $5. If you pull up a modern Fidelity trading platform or inspect the data via the Fidelity mobile app, you can see the technical breakdown quite clearly. The stock has been consistently rejected at its descending moving averages, turning what used to be strong support levels into rigid overhead resistance. For investors using Fidelity investments for long-term wealth management, including holding various Fidelity ETFs or setting up dedicated Fidelity IRAs, the risk profile of an individual asset like this often stands out as too volatile for a standard individual brokerage account. Even within a diversified Fidelity brokerage setup, professional advisors often warn that an automaker burning through roughly $1 billion of free cash flow per quarter requires an unrealistic level of operational perfection just to survive without another massive dilutive event. Let us look closely at the numbers from the recent first quarter report of 26, because that's where the expectation completely shattered against reality. The company manufactured 5,500 vehicles, but managed to deliver only about 3,000 of them, leaving thousands of expensive luxury cars sitting in storage lots while eating up working capital. This massive discrepancy was driven by that newly disclosed 29-day delivery halt on the Gravity SUV, caused by a major defect in the second-row seat components. For a brand that markets itself entirely on flawless luxury and premium execution, having to halt deliveries because an unauthorized supplier substitution compromised vehicle safety is a massive blow to consumer trust. When the news finally hit the public market via regulatory filings, the stock tumbled aggressively from its short-lived spring peaks.
Anyone managing an intelligent portfolio or relying on algorithmic rebalancing through systems like Schwab Intelligent Portfolios would have seen their risk metrics flash bright red as the correlation between production numbers and actual generated revenue fell completely out of alignment. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio and tell me if you are buying this dip or looking to exit your position. Understanding the internal mechanics of how this business operates helps clarify why the financial statements look so bleak. The company operates a direct-to-consumer sales model, bypassing traditional dealership networks to maintain total control over pricing and the customer experience, similar to the strategy popularized by Tesla stock years ago. Their primary manufacturing asset is located in Casa Grande, Arizona, supplemented by a newer assembly facility in Saudi Arabia designed to serve the Middle Eastern market. Their core technology focuses on incredibly dense, in-house developed electric powertrains that deliver industry-leading range and efficiency metrics, which is why early automotive journalists praise their vehicles so highly. But designing a brilliant powertrain in a laboratory is a completely separate challenge from managing a multi-tiered global supply chain and manufacturing thousands of vehicles at a competitive cost. Their luxury sedans carry price tags that alienate the vast majority of consumer markets, and even after introducing lower-priced variants and aggressive corporate incentives, the organic demand has remained stubbornly flat. When retail participants look for investment help on modern investing sites or execute fractional orders through the popular Robinhood app, they are often enamored by the sleek look of the vehicles rather than the underlying capital structure. Through Robinhood stock trading channels and the broader Robinhood Investments ecosystem, this stock has frequently trended as a top speculative asset. Users leverage Robinhood crypto features alongside their equity positions, utilizing Robinhood cash management accounts to store idle funds while waiting for high-beta short squeeze opportunities. But relying on Robinhood fractional shares to build a position in a capital-intensive manufacturing business can blind people to the structural dangers of persistent net losses. The company is currently losing an estimated $8 to $9 in earnings per share on a trailing basis, meaning that for every dollar of revenue they bring in through luxury vehicle sales, they are spending multiple dollars on corporate overhead, factory depreciation, and research and development costs. This financial imbalance is exactly why platforms like SoFi Invest and the broader SoFi investing community have seen intense debates regarding the long-term viability of alternative EE players. If you track user sentiment across the SoFi trading platform or analyze the types of retail allocations going into SoFi stocks and SoFi ETFs, you find a growing division between people who want to back an underdog and those who prefer a disciplined approach through an automated SoFi robo-advisor setup. A disciplined active investing approach reveals that the macroeconomic environment in 2026 has become incredibly hostile to luxury EV startups. High persistent interest rates have driven up financing costs for consumer vehicles, making a $100,000 vehicle purchase an extreme luxury that fewer households can comfortably justify. At the exact same time, traditional legacy automakers have flooded the market with their own plug-in hybrids and battery electric models, sparking a fierce pricing war that forces smaller startups to cut their margins to zero just to protect their minimal market share. The future outlook for this company depends entirely on whether they can successfully scale the production of the Gravity SUV without encountering further administrative or mechanical delays. If they can streamline their supply chain and prove to the market that the 29-day delivery halt was merely a temporary operational hiccup rather than a sign of systemic quality control issues, there is a narrow path where the stock could stabilize and begin to rebuild investor confidence. However, the shadow of the ongoing shareholder litigation represents a severe headwind that could drag on for several quarters, forcing management to dedicate valuable financial resources and executive attention to defending their public statements in federal court. If the court findings reveal that executives intentionally misled the public regarding their operational capabilities back in February, institutional capital will completely flee the name, leaving the Sovereign Wealth Fund as the sole entity keeping the company from collapsing entirely. To summarize the core situation, the contrast between expectation and reality here is as stark as it gets in the automotive market. The expectation is a well-funded premium brand poised to capture the upper echelons of the EV market, protected forever by international wealth. The reality is a company suffering from severe supply chain vulnerabilities, massive quarterly revenue shortfalls, compounding legal liabilities from disgruntled shareholders, and an operational cash burn that constantly demands the issuance of new shares, diluting the value for anyone holding a stake. Whether you manage your assets through a traditional individual brokerage via Fidelity Investments, navigate the markets through interactive broker stock trading, or execute quick trades on the Robinhood platform, you cannot ignore the cold arithmetic of their balance sheet. In a market where capital efficiency is heavily rewarded, a luxury automaker that cannot reliably deliver its vehicles without costly administrative errors faces a brutal uphill battle to justify its place in a modern investment portfolio. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Back. Don't forget to like, comment, and share this video to support the channel.